Everyone, this is Dave Keller from StockCharts.com. Thanks so much for joining us on the final bar. I want to welcome on our guest, Jonathan Krinsky from Baycrest Partners. Jonathan, thanks so much for coming on today. I appreciate it.
Yeah, pleasure to be here, David.
So you sent a couple charts, which we've got on the screen, and love to get your take on what's happened. Obviously, on a pretty a painful day for people on the long side. You sent a chart first off with the Russell 3K. What are you seeing there?
Yes, I think this is a good example of why the market has had so much difficulty really sustaining breakouts over the last 18 months. And so the Russell 3K, for those that don't know, it represents 98% of investable U.S. equities. So it's pretty much the broadest measure of the U.S. stock market. You have all different market caps in there, et cetera. And what I'm looking at is the percentage of stocks within that are above the 200-day moving average. And the index itself is actually well above its own 200-day moving average. But internally, we have about 55% of components above the 200-day. That was actually before today, so we can expect that to go down. And basically, what I've found is that to have confidence and conviction that any breakout on the broad market is going to sustain itself, you really need to have that measure above 60%, and really for more than just a couple of days. And if you go back and look at the strong uptrend we saw coming out of 2016, and then for most of 2017, you can see that for the bulk of that, we had well above 60% of issues above the 200-day. And conversely, over the last 18 months, we've primarily been below 60%. And I think that's, again, the reason that every time we kind of make this breakout on the market, on the S&P, it just seems to get a little bit above the old high and then fail and come back in. So I think that's a good reminder of what we're looking at under the hood here on the market right now.
Well, it's such a clear rotation from sort of the bullish phase on the left, more the bearish phase on the right, which is just how that's laying it out. That's a great chart. Second one was on the IGV equity.
Yeah, so that's the software ETF, broad-based software ETF, and software is important. So if we think about the market structure right now, we know there's 11 S&P 500 sectors, and then you break it down to the next level, and we get into the industry groups. And software is the largest industry group within the S&P 500 by market cap weighting. It's about 12%. So obviously a very important sector. It's been a leadership group up until, I would say, the last couple months. And I think it's at a very important and critical juncture. It's actually just kind of testing its 200-day moving average for the first time all year. Now it's still a rising 200-day moving average, so we could say that the primary trend for software still remains up. But if we look at the lower panel there, relative to the S&P, it's actually broken down to some multi-month lows. So typically, when you see relative strength breakdown, that's the first indication that the absolute chart might start to weaken. So I think software, it's going to be a critical juncture. And maybe as we get into earnings, we'll start to see if it's the start of a bigger rollover for software, or if it's just kind of a blip in that long-term uptrend.
That's a good one. And I've often told people the importance of looking at the relative strength, looking at the relative performance. That even feels like one where it's more of a leading indicator, right? You start to see the relative breakdown, and arguably you see a follow through with the absolute chart on the top, and that could be dangerous for one of the largest groups, and definitely one of the largest groups in tech. Final chart you sent was rails versus airlines, or what you called trains versus planes, I believe.
Yeah, so that's a trend we've been watching for a while. Obviously, those are both within the transport sector, very key sector. But I think sometimes it's nice to kind of get away from the overall market direction and try to find, interesting pair trades within sectors. And this is one we kind of like. So railroads have been a massive outperformer to airlines over the last 5 years or so. And that's really a function of railroads have been going up and airlines have literally gone sideways for 5 years. So if we think about the airline sector, a 5-year base, so it's obviously underperformed most assets, most equity groups. But we think that it's a decent place to go in. If the market's going to roll over, they're obviously not going to go up in absolute terms, but we think they can kind of begin to outperform in relative terms. And then the railroads, and we think are actually pretty vulnerable here. They got hit hard today. I think it was one of their worst daily declines in the last few months. We're starting to see some breakdowns. Union Pacific is one that's had a nasty breakdown below its 200-day today. So I think railroads, again, they were one of the leadership groups for the last 4 or 5 years. It's just an area to watch, and keep an eye on airlines as maybe if things do improve to break out of that 5-year base on the upside.
Those are 3 fantastic charts, Jonathan. Thanks so much for coming on. That was really, really helpful. And everyone, thanks to Jonathan Krinsky from Baycrest Partners for coming on there. It's interesting. We were just talking about transports yesterday in terms of, the question we had was looking at transports and how they relate to the broad market in terms of Dow theory. Here's actually looking within the groups of transports, looking at the rails versus the airlines and getting some signal there. Jonathan is someone that I've enjoyed talking with for years and years, have followed his work for a while. He really knows his stuff in terms of groups and stocks. So thanks to him for coming on today.